Good morning, everyone. Welcome. Well, thank you for making it out this morning on a Saturday on this cold. Well, it's not that cold, but just thanks for making the journey here. So when you're thinking of buying a house, right? So you're thinking of buying a house. So congratulations, you're going here on this journey. Before you go shopping, first thing you need to know is you need a budget. You're like, well, you need a target. You need something to kind of bring yourself in. Otherwise, right? Like there's no guide to what you're looking for. So that's why talking to the mortgage broker is important, because it's like I set the parameters. I set you, I give you an idea what your budget is, right? And we can kind of go through just giving you an idea how what's gonna cost you before you decide that you're gonna go shopping with Serge. So so Serge mentioned my slides are in the book if you want to go through it if need. If you guys want to find the page, you can jot some notes down. There's gonna be a lot of information that you're gonna get today.
Keep going.
So it'd be nice to be able to have the book to go back to and what.
No, you gotta keep going. So you stepped out of my section.
Yeah.
Keep going.
Keep going.
There you go.
It wasn't
Looking for that page right there.
Yeah, it wasn't in order, so when I was looking through it myself, but yeah, all the slides are in there, so there we go. That's fun color page here. Okay, so we'll go to the next slide here. Okay. What is a mortgage broker? So, everyone's on the slide? My former career was a teacher, so when I would get the students, like, okay, let's get our slide, get to our page. I'll wait for all of you. Okay. Second page in. Perfect. So, a lot of people, like the consumers, like, they don't know what a mortgage broker is, right? And a lot of times I come to, clients through the Realtor. The Realtor introduces the mortgage broker, but often when people think about buying a house, I need some money, where do they go? Their bank. Whoever your bank financial institution is, you go set up an appointment and think that's the only option. The mortgage broker, myself, so basically the other option is talking to myself, the mortgage broker, where I don't work for one bank. I'm licensed to to help you get a mortgage through TD, Scotia, ATB, Service Credit Union, National Bank, lenders that you don't even know that exist because they don't advertise to the public. They advertise through the mortgage broker like myself. So so as a mortgage broker, so I'm the option where I have, I can get you a mortgage through multiple different lenders, right? So I shop different lenders, gives me options. No cost to using a mortgage broker. It's the lenders that compensate me for my time, right? So I do the same work as that banker that you would have gone to at your bank, do the application process with you, and then that banker would give you their rate, their products and whatnot, and you don't know if that's good or not because you haven't shopped around. Whereas I will do the same process of sitting down with you, go through the application, but then I can say, hey, by the way, like, what's your objective? Do the best interest rate, the ease of maybe moving your mortgage to a different property if you decide to move, or what is your priority? And then we choose that lender based on what suits you. Because not all banks have obviously not the same rates, right? And the same kind of product. So that's where it's, I give you choice, result based comp. So basically I work weekends, I work evenings because it's performance based. I don't get paid a salary. So if you need an answer by 9 p.m. Friday night, guess what? I'm working 9 p.m. Friday night, right? So, and I specialize so mortgage brokers only do mortgages, meaning that banker could be doing like personal credits, the investments, mortgages. So that's more, like this, they know the tidbits of everything, whereas I just strictly do mortgages. So mortgage brokers only deal in mortgages. So then we specialize. So we know all the lenders, all the lender products, insurer products. So strictly just very, very, that one specialty. Okay. So that's what a mortgage broker is and how we're different from a banker. Myself personally, just like I said, a background in education. Because I've been in the industry for 10 plus years. I basically, have learned all the different types of lendings, and I'm also a investor. So I have some investment properties. So if you ever feel like you want to go into that area where you want to also pick up some real estate for your retirement portfolio, I'm someone that I can also be say, hey, listen, like this is my journey. Let me help you go through the process as well. Okay. Step one of getting pre-approved. Purpose, obviously, yeah, a budget. You need a budget. Right, you need to know what kind of home that is realistic for you, and then on an interest interest rate increase climate. So let's say back in 2022, 2023, we had hyperinflation, well, but inflation rates were climbing quick. So when I do a pre-approval for you, I get to lock a rate in for you for 120 days, for 4 months while you shop. If rates are climbing, that rate is guaranteed, right? If rates drop in that time between you looking and then you taking possession of your house, we can ask for a rate drop. So getting a rate locked is always good so that, it protects you from, increasing rates. And there's no disadvantage because if your rates do get, go lower, we'll just get you the lower interest rate, okay? On a decreasing rate, we don't typically do a rate hold, but if clients want it, I can offer it. My process is, I have clients go through an online. So everything can be done virtual. I don't often do in-person meetings. So everything's done virtual online application. I'm collecting documents. So the thing is, it's I'll go to the next slide. And I think it's kind of outline. Yes, the 3 things that we look for. So I need documentation on credit. Well, credit. So I'll pull the credit bureau. Don't worry about that. I need income documents. I'll need down payment documents. Okay, so the size of your mortgage. So basically, obviously, the payment, your mortgage payment, it's your income has to sustain that mortgage payment, and that's how I determine the size of your mortgage and ultimately the size of your house. How much do you make, and minus the vehicle loan. So you make the actual calculation is income minus whatever debts. If you have car payments, if you carry a high interest credit card balance, student loans, I have to take that off of the the calculation, and then what's left over is what you qualify for. So if situations where I have clients where they've got a car payment, maybe sometimes it's a good idea to pay out that car payment so that I can, that I can just now that doesn't go against your ability to qualify for a bigger mortgage, right? There's options to wait. If if I got a client where that payment, that $500 vehicle payment, can actually up your mortgage amount by 80 to 100 grand. It's because a vehicle payment, $500, your vehicle is amortized, so the life of your vehicle loan is 5-6 years. I know I've seen 7 years now. The life of your mortgage could be 25-30 years. If you take that $500 and stretch it over a longer period of time, that's the reason why you can get a higher mortgage amount. Okay? Because it's just it's that amortization. Down payment. So I'll go through this, and I think I'll go through. I need income documents and down payment documents. Those are the 2 types of paperwork I'm always looking for, what the lender needs to confirm. So down payment, owner occupied. So it's your primary residence, 5% down. There's a lot of misinformation or confusion about like first home, second home. Even if you're buying your second home and it's going to be using it as your primary residence, and you decide to keep this, your existing home is a rental and buy a new house, right, to live in, it's still 5% down. Because the purpose of your new home, it's what you're using it for. It's not that it's your second home. It's always based on, are you using that for primary residence? It's 5% down. If you want to buy a home strictly for investment, it's 20%. 20% down. The different ways so now the government's rolled out some programs. It's for different ways to save up your down payment. So the first home savings account, it's $8,000 a year, up to $40,000 for the entire amount, right, towards the down payment. And it's a great program to utilize, especially because I don't try and think with an RSP. Does anyone know how an RSP work and how it's deducted off your income? oh, maybe we'll go, we're not gonna go into that then. I'll just tell you about like these programs where it's a first home savings account, TFSA, 7,000 a year, RSP, you can withdraw $60,000 a year, 60,000 per person, so a couple it's up to 120,000, or down payment can come from gifted from family. Okay, so different, or your own savings. I don't think I added on there. So saving the 5%, and then don't forget the closing costs. So the closing costs are, because you'll talk to the lawyer, so you'll need a lawyer to close the transaction inspection. So in this first time home buyer seminar, you can meet the professionals that you're going to be working with, and that's part of the closing costs, right? It's to pay for that, for all the other professionals that you're going to be using. Okay, so we always, the 1.5 is that's a lot, right? But if you're thinking of someone buying a $200,000 house, right? That's, $2,000. Your legal fees is you'll see the legal fees is listed on your folder there, right? So that's why it's based on, even though it's percentage, obviously on a $500,000 house, that's significant. But some home sizes are smaller. But this is a good kind of estimate of how much you can save for closing costs. Income documents. So kind of like it's already listed here. I'm not going to go through every single slide and read it. I know you guys can do the reading, but typically these are the requirements that I need for income, depending on what your income type is: salary, hourly, self-employed, both incorporated, and sole proprietor. Do you have any questions? Sure. Go ahead.
Do we have to take CMHRC insurance if we are putting 5% down?
Absolutely. Okay, so I didn't do a slide on CMHC, but I'll just I'll verbalize it. So CMHC is a government default insurance, okay, that you need to pay if you put down anything less than 20% down. Okay, so essentially it's just it's not part of, so your requirement for down payment is that 5%, the minimum 5%. The lender they'll loan you that money for the insurance premium, right? And then so basically that amount goes to the government as insurance for not having the 20% that typically banks are comfortable, banks will lend up comfortably up to 80% without the insurance. But if you want to only put 5% down, they need that government insurance to ensure that anything happens when you're delaying your payments and they have to foreclose, the insurance protects the bank. It is the insurance that you pay to protect bank, but that allows you to only have to come in with less than 20%. Does that make sense?
Yeah, so lenders putting that amount, right?
The lenders will. You borrow that amount. So any banker or mortgage broker who can put together a deal, they already know. The question I always ask, like, what's your down payment? 5% down. I already know the premium that I have to include. When I quote you a payment, it's already CMHC premium included. You're not doing calculations.
Yeah, it forms part of your mortgage.
Okay.
Yeah, it's already part of the balance and the mortgage and everything I quote. Okay? Credit. Okay, so credit's something that you don't need to do anything because it's a broker that pulls your credit, but I just want to kind of show you what shows up on your credit. Okay, it's the names, right? Names, addresses, employment. It's pretty in-depth, right? Your active loans, some collection items. So I always say, anytime you have a collection item, keep the receipts for everything. Like, keep the receipts for collection items. Keep paperwork. If there's any foreclosures, keep your paperwork. Marriages, divorce, keep all that paperwork, because when Equifax collects all this information, if there's an error, and it's very common, it's actually pretty common for Equifax and TransUnion to have errors on their report, you need to have documentation we can send in documentation to kind of correct it. So if there's any collections that was paid out, but it didn't update on the credit bureau, show me the receipt, we'll send it into TransUnion Equifax, then that gets corrected off of your bureau, okay? So, sometimes this stuff does come, like the names, some of the aliases sometimes, because of I guess if it's your SIN and your name, it might cause an error if someone else has the same name. Maybe the same birthday, if it's common, right? So, yes.
Just for people to know, if they have to go through the process of trying to fix their credit bureau because there was an error, typically, what's your experience? What kind of timeline does it take to get that?
Oh, good.
It can take a while.
A long time for Equifax to review. Equifax and TransUnion understand that they have a monopoly in this industry. It's not like they're not beholden to the consumers. They're the one, it's Equifax, the main credit reporting agency, right? You have no other recourse. Like that's the one that we use, and it could take. I mean, through a mortgage broker. That's why when you talk to a mortgage, we have our channel. My channel can be a couple days, right? But that's where consumers have gone and done it themselves. Could take weeks. And in a time, that's why we do the pre-approval process. It's important to do the pre-approval process before you go shopping. If there's an error and it affects your qualification, we need that time to remedy it. Because the worst thing you can do is go shopping, have your heart set on a property, next thing you know, I pull credit and there's an error and we can't get past that. So then you gotta walk away. Okay, so that's why the pre-approval process, we look through all this, make sure it's correct, and it doesn't impede on your ability to buy. So once I do the pre-approval process with you and I say, hey, congratulations, this is your budget. And then what I end up doing is saying, hey, call Serge. It's time for you to go shopping. So then Serge takes you shopping and then you find a house, you love it, and then you're gonna write up on the property. So I step back in. So I do the pre-approval process, at least giving you an idea, giving you confidence that you can write an offer and things look good. I have got all your paperwork. Then you spend the time with Serge. It could be a few days, it could be a few months, but then it's when you have a written offer that now you and I are working again. So I come back and say, okay, we've got this contract. Now we are given, 10 days for financing. So in that contract, it stipulates that you need to get financing in place in 10 days. And now you and I are, we're working together again. So I submit the application and this is what the lender is doing. So the lender is all the documents you've given me. If there's anything, I'll ask for updated documents if it's been a while. The lender will call your employer to confirm your income. Property, the lenders will check, I guess on the MLS, ensure that what's written on, I guess the description on the property, because if you're buying a foreclosure, depending what they write, it might, trigger an appraisal. So the review of the property, income, down payment, where they're looking at the sources of all the deposits in your account for the last 90 days. Okay, so if you're buying a house, please, if you're moving money around often, in the 90 days before you buy a house, try not to move money around, right? And if you are moving money around, please have a reason and kind of jot down, like e-transfers typically have names, but when there's cash deposits or whatnot, please jot down where it's from, because when that lenders, they will scrutinize all those deposits that are in that 90-day statement. But we have to, there's banking, anti-money laundering guidelines that we have to meet. And so to ensure that any money going into that home as a down payment has to be sourced. So mortgages are highly regulated. And so these documents have to, right, just ensure that what the documents we provide is definitely being scrutinized. And then, we end up signing the mortgage documents. Once everything's approved, it's a contract with the mortgage lender. These are the terms, these are, the payments. You're signing on to a 3-year term, 5-year term. So we end up signing the mortgage approval at this time. Okay. And then once it's like, mortgage is approved, right? So typically mortgage is approved. Then after that point, it's time to pack. It's time for you to pack. Because once the waive condition, the mortgage is approved, it's like we tell the sellers that, yeah, we're ready to, let's waive the conditions. And then after that, typically, possession could be within 30, 60, 90 days, right? So, but in that period, you and I, again, I'm done with you. It's the closing process. It's when you're about to get your keys, is when you end up signing at the lawyer's office. And you're typically signing at the lawyer's office because you'll talk to the lawyer the week, a couple weeks right before you take possession. So if it's not for a few months, then you have all that time to pack and you're really not talking to a professional, right? Until the closer to when you're getting your keys. And so you and I are done, but I'm in the back overseeing the entire process because I'm in contact with that lawyer. That lawyer, when that mortgage document instructions hits that lawyer's office, if they have question, it comes back to me, the mortgage broker. So anytime it's, you know what I mean, I am a part of your process until the day you get your keys. If that money doesn't show up at the lawyer's bank account on the day of key release, call the mortgage broker. I'm back in there, involved again, on the phone, calling my lender. Where's the money? Right? People outside waiting for, key release. And then once you get your keys, aftercare service. So my hopes is that for the life of your entire mortgage, 25, 30 years, you and I are going to have a relationship. We're going to have a relationship because your mortgage doesn't come up for renewal every 5 years, 3 years, whatever your term is. I'm back in your life walking you through the different stages of, right? Like how do we, let's renew your mortgage. And what if at that time you're deciding, you know what, we're going to upgrade our house. Okay, so let's talk about maybe transferring mortgage into a new property. So our relationship doesn't end once you get your keys. It's for the entire life of the mortgage, when you move, when you're upgrading, or when maybe if there's, I don't know, you got into a big money spending era and your house is your equity, like the equity in your house, you can access that to consolidate debt as well. When you buy a house, it's an asset that you can borrow against. It can now be a tool for you to take care of your finances and a part of your financial future plans. Okay, so that's why it's not just a transactional, so it's your relationship. So yes, so you're signing up with me for 20, 30 years, guys. So
Chita.
Yeah.
One thing that maybe, sometimes people, see and hear think about mortgages, and they go, I don't understand the difference between an amortization and term.
Oh yes, sorry, you're right. Let's go back. With your mortgage is it's a loan, right? Let's say it's a $100,000 loan. So when I say the word amortization, it's the life of the entire loan, right? So how long is it going to take for you to pay off that $100,000? We can stretch that loan amount to 30 years, right? Amortization means the entire life. But your contract, every time you do a mortgage approval, your contract with the lender will only be 3 years, 5 years. That 30 years gets spliced into 3 to 5 year terms, contract terms, because we have to renew it. Because rates are only held in Canada, actually. Rates are only held, right? Your mortgage contract is only held for 3 to 5 years. I've seen 10 years. No one's saying 10 years because rates are way too high, right? But you're taking these shorter contract terms, right? And eventually, like I said, but the entire life of the mortgage amortization is the entire life for you to pay off. So when you're mortgage free, it's at the end, and I come into your life every 3 to 5 years as you're trying to renew or do something with your mortgage. Yes.
Fixed rate versus variable.
Oh yes, fixed versus variable. So the difference in your mortgage contract, there's different ways of how you can choose your interests and how the interests and the types of interests. So the types of interest is in that, let's say you decide to, get a 5 year contract, take $100,000 on a 5 year term. That's a 5 year contract. You can choose to take a rate that is fixed, meaning that rate will be the same for the entire 5 years. It's slightly higher than what would be called a variable rate. A variable rate is it's slightly lower, but it can float. It floats based on Bank of Canada and their announcements. They make announcements 8 times a year, and depending on the economic health of Canada, they can choose to increase their rate or decrease their rate. And your rate on a variable floats with what the Bank of Canada decision is. And so it is slightly lower, but it's riskier. It's riskier. I know even like utility, you can choose to have your utility on a fixed or a floating. Same thing with variable, like a mortgage. It's a fixed rate over the 5 year term of the contract or variable. So, right? So you have that option. First time home buyers, I always say, hey, listen, historically, variable has saved, more money. Historically, over a span, like if you look at history over the last, 50 years, you're right. Theoretically, it does. But as a first-time home buyer, because this is a 30-year journey, guys. Your mortgage is, life is 30 years. In that first 3 to 5 years, you're buying your first house. Let's fix it first. The reason why I say fix is you're getting into a new house. Get yourself settled into home ownership. You're gonna be spending a lot of money just to get your house into a home, right? Personalize it. So let's just fix it. The next, you have the opportunity where you've been a homeowner for 5 years, and the next time we renew, you get to choose fixed or variable in that next contract. Maybe consider doing variable, because now that it saves you money. Let's give it a try. What does the economy look like? What do you foresee it to be? No crystal ball, but if you're feeling confident, it saves you money, and you have some, extra money in the bank account to weather the highs and lows. Let's do that for the next 5 years. Right? So these opportunities to change.
Oh, sorry.
Yeah, go ahead.
Yeah, so are you saying like for the first time home buyer, the interest rate is better than the variable?
I always advise the fixed, just so that, because you know for sure what your payment is for that first 5 years.
Oh.
It will not change.
Oh.
You're not going to lose sleep. So it's just to me, it's more your emotional and mental health. You're not going to lose sleep if the payments go up.
Oh, okay.
Do you know what I mean?
Yeah.
Right? So yeah, that's why and when I say the rates are, the interest rate is slightly higher, you're probably looking at maybe a $10, $15 a month difference, right? It's not going to completely break the bank account. But again, everything with mortgages or, debt, it's the amount that you save over the years. Over the years, that's what makes the difference, right? Yeah. Any other questions?
So suppose you want to pay off the mortgage less than 30 years, what are some of the things you could probably do to pay this in a shorter space of time?
Absolutely. So I guess the most common way, and the way where you don't even notice the difference in your own day-to-day budgeting, is choosing a monthly payment frequency, paying your mortgage once a month, or paying your mortgage every 2 weeks. Consider this. There are 26 bi-weeklies in a year, so there'll be 2 months that you have 3 payments. Those 2 additional payments that you're putting into your mortgage over the span of your mortgage matters. You can take your 30 years by doing bi-weekly, and the payment difference of bi-weekly and monthly, you're probably thinking, it's like $50 difference, right? It's a very small amount. But over those years, it can save you, over 30 years, you can be mortgage free in 27 years versus 30 years. You save yourself 3 years. That's huge, right? But you don't know this difference in your day-to-day, household budget, because it's just a small change. Okay, so that's one. So bi-weekly frequency, making a bi-weekly accelerated payment versus monthly, that's the easiest. Or you can put lump sums into your mortgage. Every lender and every bank will allow you to put extra payments into your mortgage to pay down the principal. The faster you pay down that principal, because your interest is charged on the outstanding balance. So if you're chunking that, you're putting lump sums towards your mortgage balance, then that mortgage gets paid down faster. That 30 years gets, stretched down to, again, depending on how much you put as a lump sum. So you can utilize the lump sum, change it to accelerated biweekly payments. What are the other ones where I'm feeling? Yeah, you can actually, so the lump sums are you can call the lender and say, hey, you know what, in my next payment debit, take out an extra $5,000, take an extra $2,000, but you have to prompt them. You're prompting them. And a lot of lenders have online portals. But you select the online portal every time they want to do a lump sum. There's also an ability to do increased payment. It's like a set and forget. Can you increase my payment by 15%? And then you know that every single payment reoccur, it'll continue to reoccur, the set and forget. So that's another way to pay down your mortgage faster. Just increase your payments. Okay? Yeah. And every time that you have the contract end and renew, if let's say you're up for renewal, and because every lender, the lump sum is maxed out, you're allowed to pay 15% annually or 20% annually a year. Sometimes on a $300,000 home, mortgage, that's $60,000. That's big, but what if you come into a windfall, you have an inheritance, and now you've got $200,000? If you're only allotted $60,000 that year, right? You gotta wait till the year rolls over, or you just pay the penalty on the overage, right? But you can definitely wait until the year rolls over and you have another $60,000, Or you wait until that term is up. Remember that contract you did that when that term's up, it opens you up to do whatever you want. You can end up paying it all off or put all the rest of the lump sum in and only carry the balance forward. Right? So it's like when that term ends, that's why I like that the term ends, because now you can redo your mortgage if you need to add way more money. You can take out money. So it's an opportunity to make changes.
Is it after the 5 years?
You can choose a 3 or 5. It's up to you if you choose a 3 or 5 year term. So how I always do it with clients is the question is, when you're buying a house, my very common question is, okay, so what's the plan? Do you want to be in this house for the next 3 to 5 years? If a client says to me, well, no, this is going to start at home and be really, we're thinking just 3 years. Yeah, let's consider looking at a 3 year term instead of the 5 year term. Or someone says, hey, listen, like, I've got to found my kids. I want to raise my kids, and I never want to move again. Like, this is going to be their home. There's an elementary school around the corner. There's a junior high. This is my home for the next 20 years. Okay, let's take the longest term that we can take, right? So then that's why we can tailor it depending on your decision of how long you want to stay in your home. Okay, you had a question?
Yeah. If a gross family income is 150,000 annually, how much that family is eligible to? What type of housing budget that family has?
On 150,000. So we do. So when we're doing an application, we go up to 4 people on an application, and it's a household income, right?
Yeah.
So we just say all the people on the mortgage household on $150,000. I'm going to calculate that right now. Like, I should have done a slide on like how much that, just to give you an idea. You know what? Just off the top of my head, and I remember I just ran this number recently here. On a $60,000 income, I remember getting a mortgage amount of, was it $300,000 on $60,000
So
income a year?
So 5 times.
No, then the double. So doubles 120 and then add a little extra. So I would say 8? Just off. I'll run a specific number. How about at the end? If you were like, that's a very specific question. At the end of everyone else's presentation, what I'll do is I'm just going to maybe do some income amounts and what mortgage that equates to, and then I'll verbalize it to you if you guys want to jot it down. Is that good?
Yeah.
Okay. Quite a little bit.
Thank you.
But I can do that. Any other questions? Do you guys? Well, you have my phone number. Yeah, you have all my information here. Would love to hear from you guys. Listen. My time, I'm not a lawyer. I'm not clocking in. I'm not clocking out. My service is for you. Utilize me. Call me. Right? Hey, I've got questions. A lot of people say, like, I don't want to bother you. I'm like, you're not bothering me. I actually want you to call me. Please do. Please do. Don't be worried that you're taking my time.
Question. I just want to clarify it. Like when you guys say like the pre-approval process,
Yes.
like how does it work? Because like I'm kind of new. I'm not really
Yeah.
sure. Yeah.
It's like the application process. So the pre-approval is me taking it, you and I having a conversation, and I'm taking your application, and I'm qualifying based on the paperwork you send me. I say, hey, you're pre-approved, meaning here's what your income can qualify you to go out and shop. If I say get your pre-approved for $300,000, guess what? That's your budget to go shop and find a $300,000.
Oh, okay.
Okay?
Yeah.
So Chita, just one more quick question.
Yeah.
Is there a difference between pre-approved and pre-qualified?
Absolutely. So it's the verbiage, the mortgage industry. If you're pre-approved, a pre-approval means we've collected the documentation. We have done the due diligence to make sure that, like the documents that you're going to need, we're confirming income, right? If you provided documents, that's a pre-approval. Pre-qualified, I can run numbers. You know what? You can verbalize to me all the information that you have. Yes, my income's $100,000. You can tell me, I can run numbers based on what you tell me, but it's not pre-approved because you didn't send me any documents. Then you're just qualified. I'm just giving you a quote. A pre-approval means you provide the documents. You say you make $100,000, then you show me a T4 for $100,000. But oftentimes, and this is why the mortgage is like you go buy a house and it falls apart. It's because you were qualified, not pre-approved. The person ran numbers. Your paperwork came in and you forgot that, hey, you know what, that was the year that I took some time off. That was the year I didn't work for a couple months. Okay, that matters. And we didn't see the documentation, right? So then that's why there's a discrepancy between, sometimes people at the end, put an offer in house and it falls through because the paperwork wasn't vetted upfront.
Thank you, Chita.
Just one more question.
Oh, one more question, okay, for sure.
So I got re-approved for my mortgage.
Yeah.
And it's valid for 120 days.
Yeah.
You said, right? I am unable to find a house in 120 days.
Yeah.
So what does happen?
You can extend, renew it.
Okay.
So that 120 day, that rate will expire. If the rate remains the same, then we'll just extend for another, like that rate will now book a new rate.
Yeah.
It's the same rate, extend for another 120
Is there a
days.
fee for that?
No fees, no. The mortgage broker, you're not paying a fee for the mortgage broker.
Okay.
Okay?
Thank you.
You're welcome.
Okay, so,
Should I take a lot of time?